Oklahoma Watch reporter Warren Veith has been looking into Oklahoma's two-tiered tax structure and how it impacts drilling and our state's economy. Warren, thank you so much for being with us.
Thank you, Susan.
Well, first of all, what was the thinking behind the two-tier plan?
Well, if you recall, we created a two-tier plan almost 20 years ago to incentivize horizontal well drilling. At that time, it was a very rare and a very expensive technology. And what happened over the years is that now almost all wells are horizontal wells. So a couple of years ago, we came back, revised the tax structure. Now we tax all wells at 2% for 3 years, and then at 7% for 30 years or however long the well keeps producing. At the time that happened, people thought, well, that sounds like we're not giving up too much.
But they were, right?
According to our analysis, yes. What we did is we got official production data from more than 3,000 wells, and then we hired a data analysis firm called Wenzel Technology to plot 30-year decline curves for these wells. And what we found was that by the time the higher tax rate kicks in, the well will have already produced about 60% of the oil it will ever produce and nearly half of the gas.
Is this a new phenomenon everyone's just finding out about in the past 5 years or so?
Well, it wasn't too much of an issue until the last few years when all these horizontal wells started being drilled, and they don't drill vertical wells anymore. Now, I should note that the Oklahoma Oil and Gas Association is working on its own study of production declines, and their results are going to show a slightly less steep curve than ours. But even their results will show that by the end of 3 years, half of the oil's gone and at least a third of the gas.
Any idea yet how much this costs Oklahoma?
Well, a couple of months ago, two former state finance officials estimated for the legislature that if we had a uniform 7% tax rate, which is what we used to have for 25 years or so, that the legislature would have had $250 million to $300 million more dollars to appropriate this year. And that's money that could have been used for roads, for schools, for health care programs, for prisons. And I believe $300 million would be enough money to pay all the state school teachers a raise of several $1,000s.
Does it seem like a no-brainer that this should be changed?
Not necessarily. What the industry argues is that the lower rate causes them to drill more wells than they would drill otherwise. And obviously you can't collect any taxes on a well that doesn't get drilled. On the other hand, the difference we're talking about here is 2 or 3 percentage points a year. The price of oil can fluctuate that much in a week. In fact, it's gone down by 10% or more since the first of the year. That hasn't shut down drilling in Oklahoma. In fact, we have the second highest rig count in the country.
All right, Warren Veith with Oklahoma Watch, great information. Thank you for being with us.
Thank you, Susan.